So we'll stay true to our time schedule. We value your time and we appreciate you showing up for lunch to come hang out with us and learn a little bit about bookkeeping. And we do this just basically as an educational tool for everyone, to basically just kind of address the questions that maybe people are too embarrassed to ask. They don't want to ask their CPA. They don't want to necessarily ask their bookkeeper. So we're just trying to come up with topics that, are just going to make everybody in the world a better bookkeeper. So today's topic is, what the heck is reconciling? And I'm sorry, I keep looking over. I'm like trying to admit people as we as I'm talking, can't do two things at once, which is awesome. So today's topic is going to be, what the heck is reconciling? And I put in my email, I just remember my dad would reconcile the checkbook on Saturdays, and he would just sit in there and just grump and growl to himself the whole time he was doing it. And so, yeah, and then doing reconciliations in accounting 101 in college. So I can totally get that business owners that maybe never even had a business background may just not even know what reconciling means. And so that's why we wanted to get into detail on it. But we also wanted to, just for the people that do understand it, to just give them some guidelines on why it's so important, maybe why your bookkeeper is asking you for certain information to finish a reconciliation. That's an internal policy for us. Is to reconcile the books on a monthly basis. And that bookkeeper is going to get dinged by their manager if the reconciliation it looks out of whack for some reason. So that's why they're asking you for that information. So we've got a good combination of people on the call today. We've got some Lillyfield clients, and then we've also got some non-Lillyfield clients, which is awesome. Welcome. We're glad you're here. So we'll try to tailor the discussion to target both audiences. I'm on today with Erin Goodson, who's our director of all accounting services. And she's going to kind of take it away from here, and then I'll be back in a few minutes.
What truly is a reconciliation? Well, when we're thinking about a reconciliation, what we're trying to do is take our book balance, so the account in the number in your cash account, the balance in your cash account that you see in QuickBooks, and we're comparing that to some source. So we're taking that account balance and we're looking at an independent source. We try to get as independent as possible, and then we're proving that that balance can be substantiated by the supporting documentation. And really, why we want to do that is because it helps identify if there's any discrepancies, if there's any adjustments you need to make, and it helps identify errors, mistakes, if you've got potentially duplicates in QuickBooks that could be causing your number to be an inaccurate balance. And we can reconcile those balances and get them up to date. We know you're providing your financial statements, just using it to make management decisions on a monthly basis. You're potentially providing it to your lenders or your tax accountants, and you want those numbers to be accurate. And so performing that reconciliation can help identify discrepancies and any errors and make sure that you have the most up-to-date information in your financial statement. It also gives you a picture as the business owner or the business decision maker. It gives you a picture so that you can make decisions about the business. So you know the company's true financial position, and you can rely on those numbers to make decisions about the business itself. And we'll talk a little bit more about really how we're doing that comparison and how often we should be performing those reconciliations. So as Katie mentioned, our recommendation for performing a reconciliation is on a monthly basis. If you're a Lillyfield client, your bookkeeper is reconciling your balance sheet accounts on a monthly basis. And there is a sign off on there, the date of when it's done. You really want to do these reconciliations prior to actually closing the books, so that if you've got any adjustments to make, if you find an exception, you can resolve them and you can do it in a relatively timely manner, right? If something happened in January and then you don't reconcile your accounts until December, a whole lot of time has gone by, and I probably don't remember what happened in November, much less what that transaction is dating back to January. So it's a whole lot easier to make sure you're, updating your books and performing your reconciliations on a monthly basis. It's a whole lot easier to find out the cause of transactions during a timely basis. And it's also important if you're reconciling a cash account from a banking perspective. So, we know fraud is prevalent these days, right? It happens to the best of us. You've got all these great controls in process in place, and sometimes fraud happens. Well, if you're not reconciling your accounts and you miss a fraudulent transaction and you see, 3 months down the road, there's a fraudulent transaction on your bank statement, the bank may not be willing to refund you that money just because of the timing difference between when you're reporting it versus when it happened. My church actually went through this process of they had some fraudulent activity on their account, and we about missed the cutoff for when the bank would refund the money because of the how long we waited to report it. So it's important we're staying on top of any discrepancies and exceptions, catching anything, and reconciling your accounts on a monthly basis. And like I said earlier, if you're a Lillyfield client, this is being done for your balance sheet accounts on a monthly basis. You can rest assured there. Okay. What documentation do you really need to perform a reconciliation? Why are your bookkeepers asking for a bank statement on a monthly basis? Well, this is why they need it for that reconciliation. So we recommend obtaining third-party documentation. What's third-party documentation? That's a source outside of your business. It's an independent source that can vouch to the balance you're trying to reconcile. So if it's a cash account, that would be a bank statement. If it's an investment account, then that's going to be your investment statement from your investment bank. If it's a credit card reconciliation, then you're going to pull the credit card statement. And then when you're pulling that documentation, one thing you might want to think about is the date on the statement you're pulling, because sometimes bank statement dates don't necessarily align to the calendar month. So most of our financial institutions, if you pull a bank statement, that statement's going to be dated the end of the month. We have a few clients that it's actually like the 15th of the month for their bank statement pulls. If it's a credit card statement or credit card balance, then that could be any day in the month, right? We have clients that have it all the way from like the 5th of the month to the last day of the month. So you may not be reconciling to the calendar date if you're pulling a third party document. You just want to keep that in mind. If you're reconciling an accounts receivable account, your third party documentation or your documentation might be system generated information. It might be a subledger balance. If you're reconciling prepaid expenses, you might have a spreadsheet that details out all your prepaid expense items, and you're tying that balance to your balance within QuickBooks. You want to make sure that your your documentation is as independent as possible. So like third party, you want to, using a source like an email may not be the best source, because is that email, how is it supported? Right? Is it truly fact, or is it just a generated document that states a number that you can't necessarily tie back to? So supporting documentation that's best is really the third party documents. If you don't have that, or if it's an account like accounts receivable or accounts payable, you're probably going to tie it back to system generated information like a subledger that provides all the details that make up the balance. All right, so now that you know what a reconciliation is, let's talk about how do you even begin. So QuickBooks makes it seem super easy, and we perform all of our client reconciliations within QuickBooks. So there's the trail of when it's completed. And really, it's as simple as this. You're going to get your bank statement. If you're reconciling a cash account, you're going to go out and get that bank statement. And then you're going to tie that bank statement number to what's the cash balance in QuickBooks. And then success is your account is reconciled when you can match the two numbers with differences that you know how to resolve. Just as simple as that, right? Step-by-step process. You're looking at your cash balance. We're going to use the example of a bank account. We're looking at your cash balance on your company's books. You're going to compare that to what the balance is on the bank statement. It's probably not going to tie exactly because you're going to have potential differences. And we'll talk about what those differences could be. So you're going to want to review for any differences. And then if you need to, you'll make adjustments. So sometimes you'll see the bank pays interest and you haven't necessarily documented that in QuickBooks yet. So that would be one of those differences you would make an adjustment for. Other types of differences could be related to just timing in general, right? So you wrote a check to a vendor and it might take the vendor. So if you pay your electric bill by check, well, you've got to mail that electric bill. It goes through the post office, and if your post office is necessarily as efficient as it has been in the past, but sometimes it takes quite a while for that bill to be mailed with the check to be mailed to the electrical company. Then they have to take that check, they have to apply it to your account, and then they have to take it to their bank for it to be deposited, and then it clears their bank and then your bank. So there could be a timing difference between your company when that outstanding check was written versus when it's going to clear the bank. So your bank balance on your company's book might be lower than the bank balance at your bank account within your bank account, just because you've written that check. It's recorded on your company's books, but the bank hasn't yet cleared it. Thinking about it in the opposite way, you could have deposits in transit. So you could collect a check from a customer and you've recorded it within QuickBooks, but you haven't put it in the bank yet. So it could be a timing, or you put it in the bank after 2 o'clock and it just hasn't shown up yet within that bank account. There's a timing difference when it clears. So those are the primary reasons for differences in your reconciliation. And those are okay. You're just going to document those differences. They're known differences between what's at the bank versus what's in your company's account. You could potentially have missing transactions that you need to account for. So let's say within QuickBooks, your bank account connection, that bank transaction connection, it cuts off. There's a system upgrade, and sometimes it just happens where it cuts off. And you hook it back up, or your bookkeeper hooks it back up, but there could be a missing transaction because of that connection lost. And so that reconciliation process will help you identify if you're missing something within QuickBooks and you see it on the bank statement, and you can update and make an adjustment as you need to. And it could be mistakes. We're all humans, right? And sometimes mistakes happen. So maybe that connection goes down for your bank account within QuickBooks and you hook it back up, but you hook it back up on a date that's already been imported into QuickBooks. What happens? You get duplicate transactions. And so performing that reconciliation, matching what's in the bank on the bank statement to what's in QuickBooks, will help you see those differences and you can resolve them as you need to. So let's take a look at what it really looks like to reconcile within QuickBooks. So this is, you go into QuickBooks, you start under transactions, and then you'll select the reconcile screen. And from there, you can select the bank account or the credit card account or the balance sheet account that you want to reconcile. So in this example, we're reconciling a Prime Meridian Bank checking account. QuickBooks is going to give you your beginning balance, and then you're going to use your bank statement. You're going to pull the ending balance from your bank statement, and you're just going to plop it in and put your bank statement date, and then you'll hit the Start Reconciling button. So it's pretty simple to get started within QuickBooks. And then after you hit that reconciling button, you'll move to a screen that shows you the bank register, everything that happened during the time period that you're reconciling. So you'll see all your transactions, and you'll see the date they happened, cleared, and you'll see at the top of the screen what happened throughout the month. So this summarizes the monthly activity. And your goal is to get this difference balance to zero. So when you've done that, generally our bookkeepers give a big, yeah, looking good, and we can hit finish now. How do you get to this difference of zero? Well, you're going through all the transactions, and you'll select the transactions that occurred during the month. And so then let's say you've done that, but you still don't get to this difference of zero. Well, then you're going to have to do a little bit of troubleshooting. You're going to have to say, okay, think back. Do I have any duplicate transactions? Do I have any missing transactions? You can look and see if your balance is over or under and kind of do some troubleshooting there. I start off by comparing my total payments, my total deposits. So I'll compare those numbers individually on my bank statement, and I can see if I'm off on my payments or am I off on my deposits. You can narrow down where my differences are there. And so you'll go through and resolve that. You'll also want to be sure that you're looking for any old balances too. So you might have an old transaction that was a $0 transaction. You want to go ahead and clear those off too, because you don't want them hanging around forever and muddling up your bank reconciliations. Your bookkeepers are looking for those types of transactions too. Your bookkeepers will then also look and see if there's any outstanding checks that have been outstanding for a significant period of time, like over 6 months. And they'll probably ask you some questions about that. Do you think this check got lost in the mail? Do you think it'll ever clear? Do we need to look at pushing it through the state if it's an employee check? Because there's the requirements that we ensure that the check doesn't clear. We've submitted those funds to the state. The reconciliation can tell you, about the old stuff that really is hanging out there and should be cleaned up and cleared off. So hopefully you've identified all your differences. You can get to this $0 difference and you'll select finish now in QuickBooks, and hey, you're done. It was that simple. Right, Katie? So it's that simple, isn't it?
I love when it's that simple.
Yes.
Everybody loves it. Yeah, everybody loves when it's that simple. So let's talk about what accounts need to be reconciled. So really, at Lillyfield, every single set of books or every balance sheet account is reconciled before those books or before those financials ever get released. Like, we will not send you financials unless we have reconciled every balance sheet account. Now, in the interest of time, we're not going to go into how to do that for every one of them. We're hitting the big ones, which are all your bank accounts, your credit card accounts, and your loans are your big ones, especially for our cash basis clients out there. Those are the big three that we want to make sure we're reconciling. Now, if there's accrual-based clients on the call, we also will reconcile the prepaid expenses and the accrued expenses, and those are almost always to some type of spreadsheet that's detailing out the timing difference, because those are real. The prepaids and the accrueds are, relate to the timing of when those payments went out. But as far as the bank accounts and credit cards, you want to make sure that those are all hooked up in QuickBooks, meaning that if you go to the bank transactions tab, you can see a little box for every bank account you have and every credit card you have, because that brings in the information directly from the bank or the credit card company, the most recent information, and you can code directly from there. And the act of doing that is really what's going to allow or drive that reconciliation to be zero most of the time, because you're coding directly from the bank. I just onboarded a client that had their bank accounts hooked up, but they didn't have their credit cards hooked up. And so we went ahead and hooked it up and did reconciliations from kind of May of last year, and just all kinds of missing transactions. And we can talk a little bit more about that in a moment. The loan accounts, you want to do that. A lot of times people will code loan accounts either all to interest or all to principal, instead of breaking it up between the principal balance and the interest balance. You want to make sure you're capturing that interest expense, because that's going to be an expense on your P&L that you want to have on there for your tax accountant. So what can happen if your accounts aren't reconciled? Well, let's use that example of the client that I've been working with. What happened is when we brought the credit card data in, there were big gaps. So there was credit card data that was in there and then just kind of dropped off for a month or two, and then came back on, and then came on duplicated. And so it was just really, really messy. And what was happening there is they were missing expenses, right? And that's kind of a double-edged sword. If you're missing expenses, because they're over there cutting the check to the credit card, right? They're making the credit card payment, but they don't have the expenses that match that payment. So there's a discrepancy there. And now your expenses are understated. And so if you're looking at a P&L, you might be thinking you're doing really, really great, but you might be, and you don't even know that you're missing thousands of dollars worth of an expense that didn't get captured on your credit card. Now, the flip side of that is we did find expenses, so it did make the P&L, the net income go down, but that's good for tax purposes. So it's kind of which way do you look at that? That's why you really want it to be accurate, right? You just want it to be accurate because you want to be making decisions based on accurate numbers, and the way you can do that is by reconciling. So if we go to the next slide, Erin, yeah. What can happen? Well, we talked about that. Duplicate expenses. You got duplicate expenses and you're looking at your P&L and you don't know that you have duplicate expenses. You don't know that you're doing as well as you think you are, right? And you may make some decisions based on that. So let's say you have a credit card and you have a company that is really dependent on fuel, and maybe this particular credit card was never reconciled, and so there were thousands of dollars worth of fuel that wasn't added to the books or that was duplicated on the books. That's a big expense that's kind of driving decisions that you're making. Do you want to stay with that particular fuel vendor? Do you need to upgrade your fleet because they're not getting great gas mileage? I mean, those are the kind of decisions you've got to make as a business owner. And if you don't have the true expense number, the right expense number, it can be very difficult to make that decision. Incorrect account balances for your financial statements. That's exactly what I was just talking about. This is the way that we at Lillyfield know. We know we can send you a P&L in confidence because we have reconciled every balance sheet account. And that way we know there's no missing expenses, no missing revenue going in either direction. Old items that hang around and checks that never clear. Again, Erin mentioned these. They're just going to sit on that reconciliation until somebody does something with them. Whether that means that they reissue a check, they delete those duplicate entries, they're going to sit there forever. And so your cash or credit card balance is never really going to be accurate until you've managed those outstanding items. Erin touched on the undetected fraud, which gave us some great examples. Bank errors happen. We've seen it. And they may not be the most proactive bank that's going to let you know, hey, we made an error. So reconciling works in both directions. It's not just, did I make an error coding something in my QuickBooks, but the bank may have made an error as well. And then overlooked deposits. This is a great one that I've got another example on. Everybody's gone to somebody's desk that's super messy and you're like, how do you keep track of everything on here? Well, if you're doing your bank reconciliation and there's a deposit in QuickBooks that has never hit the bank, those checks may have never been taken to the bank. And that is exactly what happened with this particular client I was working with. They literally found a stack of checks on someone's desk, like kind of tucked under a bunch of folders. And they were like, oops, we never deposited these checks. And if you hadn't done a bank rec, we wouldn't have caught that, right? And then what happens then? Well, then you start calling these, your customer database or your point of sale system saying, hey, these customers haven't paid. They still are owed, they still owe us. You're calling them. They're, arguing with you. Yes, we did pay that. We did pay that. And you're like, no, you didn't. Simply because those checks never made it to the bank. So that's another big one where not reconciling impacts your business, customer service level, and decision-making level. So just to review, we're doing it, you want to make sure you're doing it in a timely manner. We suggest monthly. If you go any longer, it's difficult to remember what happened. You want to be looking for those unreconciled items and understand why they're unreconciled. Is it because of an error or is it because of timing difference? And a good internal control if someone other than the owner or the partner. So right now, if Lillyfield is doing your books, The bookkeeper does the reconciliation, the manager reviews the bank rec. So that's our internal control for you guys if we're doing your books. If you're doing your own books, or if you're the owner of a business and someone in your business is doing that, you really want them to print out that reconciliation report after they've done it as just proof that they've done it. You just want to have a good internal control system set up that you know whoever's in there doing your books is actually doing the reconciliations and doing them in a timely manner. Bank statements drop on the first of the month, so it really should not be something that they're just getting around to mid-month. It really should be something they're doing that first week as soon as the month closes. Okay, so the call to action, I love this, commit to regular and thorough reconciliations. So what I'm going to do now is just open it up to questions. I feel like people may have really specific examples or very specific questions when it comes to reconciling. So if you want to put a question in the chat box, now's the time to do it, and we can look at that. So we'll just give it a couple minutes here. Oh, we must have been really thorough, Aaron. No questions. Let's see. Let's see if the chat box will show like somebody's typing a message. Nope. All right. I think we're good. All right, so we'll be skipping, we're doing the webinars every other month right now. So the next month is going to be in August, and you can join us for QBO tips and tricks. We're going to show you some new things that are in QuickBooks that are coming out in QuickBooks, and different ways that, we use QuickBooks to be the most efficient when we're doing your books, and kind of share those tips and tricks with you guys. And as always, we do a survey after this. So if you have any ideas for future webinars or things you want to ask or questions that you would like to see answered, just let us know. And we look forward to seeing everybody again in August.